Good morning, everyone. Vinney from Bluestone Flagship Investors. And today I wanted to talk to you generically about investing. A lot of us kind of deal with that more internally and don't really talk much to others about investing. But since I'm always here and I'm always talking to you about investing, I thought I'll give you just a big overview about the type of stuff that I look at when I'm thinking about investing. But when we speak to people and we speak to investors and we ask them, why do you invest? What's really your key driver? I would say majority says, hey, I want to maintain my lifestyle. I want to create investments that's going to give me extra cash flow so I can be more comfortable. Others saying, hey, I'm really trying to exit out of my work. I want to try to build that passive income so I can actually, sit back and just have money come in from a mailbox standpoint. And others already have completed these two and they say, hey, we're trying to build a legacy for our kids down the line. But, the biggest challenge that we see is in investing, it's not always very trivial. So each investor deep down inside, even though they might not verbally relate that to you, is they always have fears when they're looking at an investment or thinking about it. And typically a lot of those fears is in many of those areas where, hey, is this investment real? Is it a Ponzi scheme? You've seen what happened with Madoff. You've seen a lot of things, and people like, oh, what if I buy it? Do I really understand what am I investing in? So there's always these thoughts that are happening in the back of the mind of an investor when they're really trying to invest. And to really sum it up, I wanted to give you an insight of what are the ultra wealthy, these people that are actually worth 10 million, 20 million, 30 million and up. How do they really invest? Well, first of all, they actually have a dedicated team. They're called wealth advisors. Probably in our scale would be like a financial advisor, but their scale is a wealth advisor that are versed on a whole lot of different scheme of the various different type of things to invest in. But this is actually Tiger 21. It's a group that actually gives a breakdown where are the ultra wealthy investing their money. And as you can see, a lot of us know things like stock market, stocks and bonds. But as you can see, it's a very small amount of their money is put into stock and bonds, even though majority of us significantly contribute a lot of their retirement into stock and bonds. But they actually contribute big part of their wealth in kind of what we call alternative. Alternative means things that's not stock and bonds, things that's not in the public market. Typically private market, just like you can invest a stock in an Apple, which is a publicly traded company, you could also invest into a private company. And that's difficult stuff to do because it does take us professionally. You have to really work with dedicated investment specialists that really understand the various things. I would say most of us are a little bit more common with, hey, real estate, that's an avenue where a lot of people maybe own a home or they rent out the home. So that's a little bit more understanding for a lot of us. But I wanted to give you a taste of what really the various aspects that are available to invest, not in the public markets, but in what we call the alternative. And probably not many people know that you can invest in collectible. I know a lot of people are watching crypto and they're talking about crypto. There's fine arts, there's oil and gas, there's so many different things to go invest. But it's probably not easy for the common investors, you and I, to really be able to dive into a lot of those areas because it does require specific expertise. So the next thing is okay, when you start looking at these various type of investments, in your mind, at the end of the day, your whole goal is to grow your wealth. You're going to invest capital. And majority of these investment, when you think about it, it's always going to have the long-term growth. If you're invested into the right product, into the right assets, into the right companies, you're always looking for the long-term growth. But there's two unique differences about two investments that I want to point out in here. One of them is real estate and one of them is oil and gas. The unique difference is not only that you're betting on that future growth, but there is a component of cash flow you can actually live on. Just like you invest in stock and bonds gives you the cash flow while the stock gives you the growth or the appreciation. Very much so here in oil and gas and in real estate, it does have that unique combination, as well as some of the tax benefit. But the key thing why people invest in alternative is they're looking to diversify their overall wealth so they don't have to have too much correlation to what's happening in the stock market. So that's really effectively, from a big standpoint, why do people invest in alternatives like a real estate? Mainly because they're looking for diversification. Because Down the line, let's just say you're retired, you're depending on that money coming in, something happened to the stock market. You don't want to be in a position where you have to sell at a loss. You want to hold it a little bit longer. And in the meantime, that's why you have other assets to fall back onto that could provide you basically a little diversification outside the stock market. So the benefit for all of us that invest, and specifically alternative, again, is to grow the savings, me be able to retire sooner, create more cash flow, maintain existing life or have a better life further down in retirement. And at the end of the day, really create a diversification for what our wealth is. Nobody wants to be old in Apple. Nobody wants to be old in NVIDIA. At the end of the day, we're really looking to diversify. And when I think about investing, I always think about, hey, I'm giving my portfolio for stocks to my financial planner, and they're putting in the various different indices. But when it comes to my real estate, this is how I'm looking to actually diversify. Last time when we presented here, we talked to you about why real estate for me is specifically interesting is for 3 different aspects. One is it generates cash flow. For cash flow, I could use that to live on. Second, it creates appreciation. Over time, the investment that we have is appreciating, so it increases in value. And there's all the various different benefits that's associated with the tax aspect of it. When it comes to real estate investment, there's so many options to invest in real estate. Yeah, some people buy a house and they rent it out, and they do well if they hold it long enough in time. But when I think about real estate investments, I look at various different things. There are many different products within real estate, or at least commercial real estate, where I like to focus on. Typically, like multifamily is like apartment buildings that are typically 100 units, 100 apartments to 400 apartments. Storage, these are like the large storage warehouses, those U-Haul or these orange storage, investing in these type of projects. Industrial warehouse, retail, and land. There's definitely many options. I tend to focus more on, I would say, the first 3, even though I've done actually also investments in retail as well. But when you're thinking about an investment strategy in real estate, there's a different level of a risk return. If you invest in what you call core, very stable, very, very predictable, you're going to get a much lower return, but very predictable from a risk return standpoint. You can do what's called a core plus, where it can actually get slightly higher return at slightly higher risk. Where I prefer to actually invest typically when I'm doing my investments is what I call value add, which is typically buying a underperforming property because it's older, because it's not fully occupied, rehabbing it, improve its operation, improve its income, and get it up to its highest level of potential, and then exit from that property at the highest valuation. So think about it as like, hey, I want to buy it low, improve it, and then sell it high. You see a lot of people in the residential space, for example, buy a distressed home, an older home, fix it up, maybe expand the square footage, and then sell it at a premium. That's the type of stuff, but we'd like to do that more on the commercial space. And typically what the investment cycle for us is, like I said, we go find those underperforming properties. We do enough of the analysis on the due diligence to say, yeah, we really like those markets, we really like the potential, the growth. We work with the operators that can acquire these properties, rehab these properties, increase the occupancy, reduce their expenses. Believe it or not, in Houston, one of the properties we're looking at right now, the government is giving an incentive to take 25% of the units and make them into low-income housing, but they're reducing the property taxes by 80%. So the net benefit from an investment standpoint, it's going to increase the overall return of the property, even though you're going to be limiting the cap of how much you can increase rents. And then finally, once the property is stabilized, means it's reached its peak potential, peak earning potential, this is when the property gets sold. And the reason you want to sell it at that point, because you're going to get the highest level of multiple. So you bought it, 60 cents on the dollar, you cash flowed it while you have it, and at the end of the day, it reached its highest level of potential. This is the time that you want to actually dispose of the property. So just a reminder, this is who we have at Bluestone. Jesse, myself, and Ruta is an advisor. We basically leverage a relationship with these larger sponsors that actually work on these commercial real estate investments. We apply our criteria of stringent due diligence to make sure these investments meet our criteria. We negotiate specific returns with these sponsors. So typically they have improved economics because we come in at a larger check, at a larger investment, more than an individual investor. And then we pass that on, we invest in those, and then we actually, alongside our investors, where we actually pass these improved economics all the way back to our investors. So if you know anybody who is looking to diversify their portfolio, they are accredited, means they have a certain level of net worth, please have them talk to us, and we'll find out if commercial real estate investing would make sense for them.
And what is your average?
Majority of our investors on a per deal basis are going in at 50 or 100K per deal. Typically in every deal as a group, we're going in about $1 million. But on the back end at the individual investor level, we're anywhere between 50 to 100K per investor. Typically our investment cycles are about 5 years, 3 to 5 years. And we only go look for deals that at least going to double our money in the next 5 years. So from an average annualized return, an ARR is 20. If you look at it from an IRR, which is time specific, it's going to be anywhere between 14 to 17. But we don't really pick a lot of the deals based on return. There's so many other metrics. We try to look at the highest level of return at the lowest possible risk. Can we go into projects that's going to go 25% return per year? We can, but there are significantly more risks. So we like to find the ones that, because we are investing our own money in each one of those deals, we like to find the ones that give us the highest level of return at the lowest possible risk.
What's your percentage of your own investment?
We typically invest 50 to 100K in every deal, our own money. The company, Bluestone invests anywhere between $500,000 to $1 million per investment, per property, typically. And typically, if it's a sponsor we've worked with before, we have their track record, we're happy with them, we go larger. If it's somebody we're trying out for the first time, we actually scale backward. Even though sometimes we have investors who want to put more, we ask them to hold back until we really try the sponsor and get comfortable with them.
Gains at the end of 5 years, long-term capital?
Yes. There is also, because there's depreciation and everything, there is recapture depreciation. It is a long-term capital gain. But typically what we do is, majority of our investors take that money and they roll it into the next deal. They take depreciation from the new deal to offset the gains from the other one. And they keep basically the cycle going. They do have to work with the accountants to make sure it's efficient. But again, people don't have to invest with their own cash, even though we're recommended in many, but they can invest through the retirement account, if they're worried about taxes. Yeah.
Do you offer part of your advice, taxes?
So anything, we connect them with proper CPAs that understand real estate, but typically anytime an investor is a limited partner in each one of those deals is receiving a K1, and a K1 is the form that they have to take to their accountant for them to actually do their taxes. The benefit of kind of investing through us is, let's say an investor is invested in 4 different deals. So instead of them getting 4 different K1s, the CPA for Bluestone actually combine all their K1s so they can get a single K1. 1 minute left.
Can you tell us about the last couple of deals?
Sure. Yeah, no, absolutely. So for example, for this year, we've done actually 0 deals in equity in these things because we were basically saying that, hey, the interest rate is still high and the market is not correcting. So we continue to wait until we actually find the right deals. But for example, the last deal that we invested in the equity side, not on the debt side, was in December of 2020, exactly a year ago. Each investor, let's say they put in $100,000. They received about $90,000 of year 1 depreciation. They can use that depreciation to offset other real estate related income. And the project within 3 months actually started kicking out cash flow. Typically for that type of project, because it's a value add, it's going to start in the 4% range. It goes up to 5%, 6%. It only stays in the single digit as far as the cash flow. But once it's actually done, which is typically in the 4th or 5th year, is really when you have increased the net income. For example, on a Dallas property that we acquired in 2022, right now we're 50% higher in terms of the net income. And remember, the valuation of these properties is a multiple of their income. So if we increase the income by 50%, we basically increase the value of the property by 50%. So that's really the name of the game, is to acquire them where the income is low and grow the income by either increasing rents, rehabbing units, cut down costs, and so forth. So that's typically what a cycle would look like.